Good morning. This is R.N. Bhaskar from BKBB, which is an acronym for Bhaskar Ki Business Baatein. This is a channel that comes to you on Saturdays at 8:15 with a look at some of the major headlines during the past 1 week. And yes, we have another platform, the mother platform, which brings you policy analysis, corporate stories, conversations. Do visit that as well. And most important, just today, we put up a podcast which is about import of pulses and how the government is not corporate, is not farmer friendly. Anyway, let's come to today's story. And today we're going to do 3 stories, and my co-anchors are Katya Naidu, Hussaina, and Saloni. And together we'll discuss the following stories which you can see on the screen. The first one is how uncertainty grips the IT markets. Then we have a story on how IPO markets are booming despite choppy market conditions. And we have a third story about how India loves boycotting any ranking when it doesn't suit the country. We'll talk about all of them, but let's begin with the first story. Saloni, can you come in with your story?
Yes, sir. So fund managers are disagreeing about how much to invest in information technology stocks right now. Some fund houses have very high exposure, around 18% of their equity portfolio, while others have very low, around 5%. This big difference comes from a report by Nuvama Alternative and Quantitative Research, which measured how different mutual funds hold IT stocks compared with the Nifty 200 index. So the Unit Trust of India Mutual Fund has the highest IT exposure at 17.8%. On the other hand, SBI Mutual Fund has just 5% exposure. The Nifty 200 index as a benchmark stands at 10.8%. So, if we ask what's driving this difference, the answer is IT stocks fell a lot after September 2024. So, some managers think they have become a buying opportunity, while others think risks are still high. Talking about the reasons for the fall, earnings fatigue. Companies are not growing profits as fast as they should, and worries about the artificial intelligence and other changes are affecting IT companies. And talking about the current situation, despite the lingering near term uncertainty, the second quarter numbers are stronger than expected. The Nifty IT index gained over 6% in October and is up 1.7% so far in November. However, mutual fund activities stayed flat during October. Sir, apart from IT, fund managers are also split on banking stocks. The Nuvama report shows wide variation. 4 of the 11 large fund houses held 14% in banking, while others ranged between 17 and 24%. So, in short, there is no consensus. What's your take on this, sir?
Thank you, Saloni. A very interesting news item, not just because of mutual funds, but because of AI. The bugbear which is biting the markets is IT. All of a sudden, AI, which is touted as the wonder kid down the block, is something which has been seen as a hyped up issue and may not be as attractive as people thought it would be. And that in turn has scared off many investors. Valuations have changed. Even companies like Nvidia saw a big collapse. And all of a sudden, funding for AI is also dropping. And this is sharp contrast with countries like China, which don't depend on markets for critical applications. Instead, the government creates the funds to make sure that the applications and the research do not stop irrespective of market conditions. Anyway, Katya, what do you think about this?
So IT companies have seen an unprecedented growth during the pandemic. So they raised salaries, they're facing attrition, they went through whole hype cycle. The problem is after interest rates cuts have not panned out, or they were in a limbo, and there was no money for discretionary spends by US and European clients because of their problems. Their revenues have gone down substantially. In fact, companies even say negative growth. So, which is actually a very bad thing for because these are seen as behemoths. The third problem is the AI bubble that's also surprisingly bad for them. AI itself is, might be eating into their business. AI bubble is, which is bursting is also bad because a lot of these companies have made announcements 2 3 quarters back saying we are getting into AI, so that improved their valuations, but that too will now bust. Third problem, the real problem which most of them don't seem to accept, is the rise of GCCs, sir. These IT companies might not be getting a lot of this revenue, a lot of clients, because GCCs now are preferring coming directly to India and set up shop here. So that is also huge revenue loss, and very few guys also see a lot of growth from here. And most of these funds might also be in passive funds because Nifty 50 has a lot of IT stocks. Nifty 100 as a light stock. So a lot of these exposure could also be passive stocks as well, passive indices as well.
Thanks, Katya. Let's see what happens because even companies like Sun Microsystems is
Right,
now facing, Oracle is facing trouble.
right.
But let's see what the markets bring in. Let's take the second story, which is also market related. Hussaina, could you come in?
So, this year India's IPO market it is witnessing a blooming shift, and it's not about flashy new listings, but about who is actually selling in those listings. So, secondary sales, which is through offer for sale or OFS, are rocketing towards the $1 trillion mark, which is, let me tell you, is reaching their highest level ever. So since January 2025, nearly rupees 96,000 crore has already been raised purely through OFS, overtaking last year's record. And if the pace continues, OFS collections alone may cross $1 trillion for the first time in a single year. Meanwhile, total IPO fundraising so far stands at around rupees 1.53 trillion, which is still slightly below last year's peak of 1.59 trillion. But the key insight here is that 66% of all IPO fundraising since 2015 has come from OFS and not the fresh capital. Also, I think it's very significant because fresh IPO money usually goes into growth, that is your capex, expansion, new projects, etc. etc. OFS, however, is different. It's a sign of existing investors or promoters selling part of their stake. Now, this often includes private equity funds exiting or trimming positions. So, that may look like investors are simply cashing out, but experts argue otherwise. They say that mature cash generating companies don't always need fresh capital. Instead, OFS can still serve productive purposes. So, PE funds recycle capital into new ventures, and also promoters redeploy this money into fresh businesses. Now, the question that arises, sir, is what is driving this wave, especially in 2025? A big push is coming from new age companies like what happened with Lenskart, Grow, and Pine Labs, where OFS has often exceeded fresh issuance. Now, early investors have made strong returns, which triggering large secondary sales. But the concerns that retail investors are being left out or that PE funds are exiting at their expense have been dismissed by market participants. So many experts are arguing that India's IPO ecosystem has matured, and as companies grow and reach governance stability, they naturally turn to public markets for exits, which is very similar to what happens in Western economies. Even when we talk about debates about IPOs becoming exit routes, regulators maintain that a mix of primary and secondary issuance is healthy. So, different companies have different capital needs. Some raise fresh funds for greenfield projects, while others simply allow early investors to exit. So, while India's IPO market is no longer just about raising new money, it's increasingly about transferring ownership. And with OFS dominating the landscape in 2025, what do you think about it, sir?
Everyone seems to be going the IPO route, and we're raising so much of money. I'm not sure whether all the IPOs will sail through because they seem to be overpriced and they've been dressed up to look very attractive. But Katya, can you throw some light on this?
I'll give a little bit of perspective. 2021 offer for sale is very high. I'll tell you what's different. 2022 end second half, the IPO market started their revival, but OFS is low both the years, and it picked up again in 2024, 2025. That's because 2021 had a clutch of new age companies or startups which invest Zomato, etc., which kickstarted the market. And then they went through a bad phase. When the phase picked up, 2024 and 2025 saw a huge amount of these companies coming in. So when we actually, and then like she said, the private equity, the VCs, the large VCs, a lot of startups are not owned by promoters, don't have large stakes like in traditional companies. They don't have 35, 40%, 50%. In fact, VCs hold the largest stakes in startups and new age companies. So, like you said, it's VC exits. So, and more importantly, a lot of buyers of IPOs these days are also institutions and mutual funds, as
Right.
opposed to retail investors. So it's actually a lot of case of institution to institution fund exchange is what a lot of markets are worried about. But there's nothing illegal about it. Anybody can go for any offer for sale. It's up to the market to pick it up. So this is my view on it, sir. What do you think about it?
Well, I hope investors don't get their fingers burnt like they've done in the past also. But again, it's a nice way of raising money. And well, let's see what the markets mean for investors. I
And
don't
then
want to predict.
because of VC exits, also FDI, also the net FDI numbers could also get impacted because these are large amounts that are
Very
being.
true. And there's a third story. There was a very interesting news item in the news in the papers saying that India rejects rankings by overseas agencies. That is because the QS rankings, the university showed that all the IITs had slipped rankings, all the Indian universities had slipped rankings. It's a bad carpenter blaming the tools. Remember in 2009 when we had the PISA scores, when India's schools performed so disastrously, we came second from the bottom. And then the government said, we do not accept the PISA scores. And after that, they refused to go in for any PISA evaluation thereafter, including last year. And now we kept on going with the QS scores, we kept on going with the university scores, because at least in the top 150, we were there. Indian universities were there. And so we said, okay, fine. But now when the story came out that even among the 150, they've slipped further and have gone out of the 150, all universities, the government took panic. Obviously, they reflect on the government's saffronization policies, its interference with the managing committees, with the boards in universities, and not granting them the autonomy that education requires. And so now India says that no, 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 we don't accept these rankings. These rankings are not fair. Well, the fact is, every survey has shown that India's education is getting worse. Right from the school level, where 70% of the schools are government owned, to even the universities and centers of excellence. The way the government has treated students of some select universities like JNU is not fair, is not good. And the result is that it leads to unemployability. Look at the next chart that you can see. On almost every sector, Indian graduates are not being taken in because of unemployability. When universities do not bring the right category, right grade of students that employers want, they prefer to take a person from overseas. Or the market becomes smaller. And some jobs are not even created in India because you don't have the skills. This is exactly what's happening in America. When Steve Jobs said that, look, there are some skills we don't have, and they outsourced it to India. With AI coming in, even these jobs are going. So what will India do? Well, it'll face more unemployment, more dissatisfaction, and blaming the rankings and saying that we don't accept the rankings is the wrong way. It makes India look like an ostrich, burying its head in the sand. Anyway, that brings us to the end of today's session. I'm not taking any questions because we've already exceeded the time quota. But yes, do tune in next Saturday, once again 8:15. And one more reminder, do watch our latest podcast on pulses and how the government is market unfriendly, is farmer unfriendly, and is nation unfriendly as well. See you again next week. Until then, have a wonderful time. May the weekend be wonderful for you. May you have all your achievements in the coming week. And then we meet and talk about what the major news items of the next week. Next Saturday, 8:15. Take care. Good luck.